Welcome everyone to our final Kickstart webinar number 7. This is week 7 of the Kickstart program we introduced 7 weeks ago to prepare everyone for the Mastery Series and also give an opportunity to current JD members to check it out, see if they'd be interested to go forward with the Mastery Series. So Jim and I want to thank all of you for attending these weekly, asking great questions, and being a part of what we do. We really appreciate it. So welcome to the final one. And next week we begin the Mastery Series May 1st, Monday. And right now, if you are unaware, we are doing 2 daily reports, and Jim is making chat comments at the training site. So those 2 functions of the Mastery Series educational model will continue, and next week we will add the morning webinars from 9 to 10:30 a.m. Eastern. Okay, so if you'd like to talk with me about the upcoming program or anything that's going on that you feel you would benefit from speaking with me or emailing us, please let us know. We welcome it. So I think that's all I have. I did place the slides in the handout section. We have Mastery Series traders asking for the webinar schedule. You can go to jdaltontrading.com. You will see that in a comment I put on the question board here. You can go to jdaltontrading.com at Mastery Course, and below the graphic, a couple of lines, you'll see Download Market Profile Mastery Series Webinar Schedule. So that'll give you a sense of what we'll be doing for the next 5 weeks. And of course, we add webinars. The first webinar we're going to add, and it'll be there, you'll be notified, is the Friday webinar. We do not start at 9 a.m. on Friday because it's the first Friday of the month, May 5th. So on the Mastery Series, we're going to come on at 8 a.m. Eastern so that we can talk about the non-farm payrolls release, the number release, the monthly jobs number, and Jim has a lot to say about how we handle that release, how the market responds to it, and how we will incorporate that into the open at 9:30 a.m. Eastern. So that webinar I don't believe it's on the schedule, but you will be notified. And again, I have a couple of questions here. You do not need to register for any webinars. You are automatically registered. You will receive notifications and reminders from GoToWebinar. If you miss one, you will get a reminder, hey, you missed the webinar, in case you were unaware. So you don't have to worry about that. You just sit back, relax, do your trading, listen to Jim, read the reports, and do what you do to help yourself, and we're here to support you. Okay, so with that, I'm going to turn it over to Jim. Hi, Jim.
Hi, thanks. Okay, I'm going to go to the slides in just a second. But we'll come back and talk about this market. It's a very low confidence environment in this market this morning. I have no real clear understanding what is going on. After it failed to get to the all-time high, broke down sharply, closed the upper distribution. The expectation would be for downside continuation. That didn't happen. I suspect that the break was caused by a statement that Paul Ryan made about the spending bill not including critical payments to insurers. I can't be sure of that, but it is a very low confidence, difficult trading environment in here today. One of the things I put on the chat today, you have no requirement to trade in these environments. If you're unsure, stay away. It's a tough environment and a lot of volatility. Okay, let's go to the slides. As Julia said, this is the last of the Kickstart programs, and the design of the reason for the program was to take those, to help those of you who really are not that familiar with what we do, and give you a chance to be up to speed, have a pretty good idea of what the terms are, etc., when we go into the full program on May 1st, on Monday, May 1st. Additionally, in order to strengthen that process, for the last week, we have been in full operational mode with the exception of the morning webinar. We are issuing both reports, and I am full-time on the chat node. That wasn't the plan was going to be just to warm up and minor chats, but because the market's been interesting and because of where we are relative to the all-time highs and the uncertainty, I've been on full-time and will continue that through Friday and then back again on Monday. Start with prospect theory by two professors, Daniel Kahneman and Amos Tversky. I first got interested in prospect theory. Assumes that gains and losses are valued differently. And why that resonated with me is because I have been very much into behavioral economics as a trader, understanding the important part that psychology plays in trading. Both of these professors, as you can see, got their Nobel Prizes in behavioral economics. Amos has left us, but Kahneman is still very much with us, and the most often quoted or referenced person I encounter when reading anything associated with behavioral economics, or in many cases about the markets. I am just amazed at how often Kahneman's name comes up. The book that we have strongly recommended, Thinking Fast and Slow, is by Daniel Kahneman. And that's something that we continually talk about, that as traders, we have a fast way of thinking and a slow way of thinking. I have tried on the chat, I have tried to point out some potential trades for fast thinkers and some potential trades for slow thinkers. Takes a totally different personality, in my opinion, to engage in these kind of trades. But the final thought I have in here today is one of the things that Kahneman has said is that people are irrational, which doesn't come as any surprise, but they're irrational in a predictable way. I think that is really what is so very important. And we see this herd instinct all the time. It was interesting, yesterday we made a new high a new all-time high in the NASDAQ, as well as the first time it crossed the 6,000 mark. It was back in about the year 2020, or about the year 2000, when we hit the last high, or a previous all-time high on the NASDAQ, and then it was many, many years later before we returned to that high. And clearly, people that want to think that markets are rational, the markets didn't go to the extreme high that they went to back in 2000, break as hard as they did, and then come back if, in fact, traders and people in general were rational. They're not rational, in my opinion, but that actually plays into the advantage of trading, knowing that they are irrational, but in a predictable way. And looking at that predictable way is very, very fascinating, and I think creates some opportunities for us. As we go to the next slide, what we've tried to do throughout the Kickstart is bring out the point: you're a trader, not an investor. We don't approach investing. We don't talk about how you be an investor. We talk about how you would be a trader. The difference between being an investor and a trader are miles apart. Confuse the two, and your frustrations will expand exponentially. Translated, your frustrations will rise at an unusually rapid rate. And I understand a lot of times when I hear certain questions will alert me to the fact that traders are confusing trading and investors. Trading and investing. Trading is generally much more emotional, much shorter term in nature, and subject to tremendous swings in inventory corrections. Markets so often get too long, you get a liquidation, they get too short. Go from one extreme to the other. That inventory gets too long in the day time frame, intermediate time frame, and even the longest of time frames. And it's sorting that out that really helps us identify risk, helps us identify potential trading opportunities. There's two types of traders we have tried to address. There are price-based traders, generally referred to as momentum traders. This is the easiest strategy to employ and by far the most often employed. Because it's the easiest and the most often employed, it is also the one that is subject to the most subject to the herd instinct and the most subject to seeing markets get tremendously undervalued and overvalued in all time frames. What we're talking about is we are called value-based traders. Most difficult to employ and learn. In the value-based, everything is a series of facts surrounded by the other circumstances. And the other circumstances are really so important. As I think it was one of the Greek philosophers said, Heraclitus, I believe, no real learning starts without understanding the context associating what you are learning, what you are trying to learn. The value-based, I don't want that to be confused with investing. When we're talking about value-based, we employ the market profile. And what the market profile does, it records the auction's continuous two-way auction process. And markets auction higher, they auction lower. You'll hear us talk about value. Value is where approximately 67 to 70% of the trade occurs in any one particular day. And by just taking the opinions of the buyers and sellers, focusing on where the majority of that trade is taking place on each day, that's what we determine to be value as of that period of time. It's not value as you would think about it if you're buying a car or a house, but it's value based upon the different opinions of the buyers and sellers. We think that this value-based approach allows us to better identify opportunities on their own, and particularly opportunities that are identified when the momentum traders have taken prices to extremes. And just to make it clear, a lot of times you'll hear people talk about contrarian trading, and they'll say, I'm a contrarian. And when I hear somebody say, I'm a contrarian, I just kind of shudder because they're kind of identifying themselves and putting that label on. And what the better understanding is, where you want to be a contrarian, you want to be a contrarian at lows, and you want to be a contrarian at highs. And I think looking at value-based assessment of markets allows you better to do that. So let me go back to this contrarian concept. So if you've identified what looks like a low, no matter what time frame, and we say that excess is the best way to identify the end of an auction. So if you have a market that sells off sharply, rallies sharply, leaving an excess low, that the odds are good that's the end of one auction and the beginning of another auction. And from there, what we would hope to be is contrarians at the low. We would like to be momentum traders in the middle of the rally as the rally is going higher. And then again, we would like to be contrarians on the other extreme. So markets, if you remember that we talk about the diffusion model, and if you're starting from a low to high, you'll have the innovator, which is the first person in, the early adopter, early majority, late majority, and finally the laggards. So if you think about that, you say, okay, as a contrarian, where do I want to be along those lines? So at this point in time, I just want to focus on the clearness of being a price-based trader and a value-based trader. We are value-based traders, and that's the information that we're trying to impart. So the question is, where do we start? And as I'm making these slides, understanding how the marketplace allocates the constant flows and bids and offers coming into the market. The number of opinions that everybody has is too numerous to even begin to come up with. Why people are buying, why they're selling, and everybody, there seems to be so many different reasons and thoughts, and what we're really trying to do is sort through those. So where we start in that sorting process is by looking at the two-way continuous auction process. That the market, and I'm going to go and I'm going to show you that process based on yesterday's trading to make it a little clear. But it's continuous two-way auction process, but it happens in multiple time frames. So you may have one auction, you may have a long-term auction going higher, you may have an intermediate term auction going lower, and you may have a short-term auction going higher. So it happens on multiple levels. But what we do in order to view this continuous two-way auction process is organize the data via the market profile. And as you'll see when we look at yesterday, each auction reveals new information. And as I just mentioned, you have multiple time frames, starting from the very long to the intermediate to the very short, and it can get very confusing. That's why we organize the market. One of the reasons that we do our educational programs through immersion learning, it's just like they do on some of the language courses. We want to look at the market as a whole for trading, and we think trying to do it any way other than immersion learning leaves too many little pieces, and it gets almost impossible for you to ever connect those pieces. Learning through maybe a more formalized presentation, a more linear instruction, sometimes makes people feel better, but I've never seen, from all the teaching and trading I've done over the years, I have never seen satisfactory results from trying to teach trading via a linear type of approach. There's just too many things that happen. So we focus on the immersion learning. Next I'm going to go and I want to see that in action. But before we go to see it in action, based on using yesterday's model or yesterday's profile, let me see if there's any questions up to what I've covered at this point. Julia?
Yes. First of all, Chris, if you cannot find the slides in the handout section, it may be your browser interface, I don't know, but you can go to the training site and under webinars, Kickstart upcoming webinars, you can download the slides there. There's not many of them. Would you conclude that based upon the monthly chart, we are seeing a buildup of a long liquidation break of long-term traders, or am I incorrectly identifying long-term traders and their inventory?
Yeah, I don't think that's really not where I want to go just yet. I really want to stay on just the theory that I've talked about so far. We'll get into markets and we'll have time for those questions a little bit, market questions a little bit later. But this whole educational process and this idea of identifying the different types of traders, price-based traders, value-based traders, we're going to define that even closer in a little while by talking about fast traders and slow traders. But any basic questions before I move forward? It sounds like there may not be.
No.
Okay. Okay. Strange market. If you think I understand today, you're crazy. I don't. All right, I'm going to split out yesterday's profile. And let me put in the overnight. Okay, as we came in to yesterday, the market gapped higher. As the market gapped higher, that is an indication that change has taken place overnight. It's a change in thinking. Some news, it may be some news, it may be non-news related. I suspect that yesterday was related to, the second time we've heard about the, tax proposal and all that type of thing. But when we come into yesterday, we have the rules for trading gaps. And the gap rules are relatively simple. Go with all gaps that aren't filled fairly quickly. Now, when you get a day like yesterday, an awful lot of the traders are riddled with fear. Well, the first thing, there's a temptation that we see traders want to automatically fade a gap opening. And we know that there are a lot of people out there teaching trading that tell you should fade all gaps. And I heard that many years ago when I was on the floor of the Chicago Board of Trade. And, at that point in time, it may be valid. It is certainly not intelligent information right now. But change has taken place. When you get a gap, change has taken place, or the potential for change. If the gap fails, in other words, we gap higher and then the market sells off with some conviction, then the market explored from an auction process, it explored a higher range and it was solidly rejected. So rejection is one thing. So if the market gaps higher, price sells off, gets back into the previous day's range and starts to extend on the downside, we've got a pretty good idea that was rejected from an auction process. Now you take a day like yesterday, and remember, I can promise you that there are a tremendous amount of traders that want to short it, tremendous amount of traders that are absolutely petrified because of the higher price and wouldn't take that trade for anything in the world. And what we're saying, okay, let's take a look at the gap trading rules. And the reason I'm focusing on this right now is I'm going to talk about a slow trade. In other words, a trade that is done by a trader that is a thoughtful trade. I mean, it may have happened pretty quickly, but you had the time to process the information. You follow the overnight market. You know from where we close on the overnight market if we are or are not going to gap higher. So it's clear by the time we get ready to open, it's clear that we have a gap opening. So it doesn't require fast thinking. Then yesterday, the market gapped higher, traded just a little bit lower, and within a relatively short period of time, the market was above the overnight high, nice easy reference, and never gave anything back. That is a trade you should be long. Going by the gap rules, that is a trade you should buy. And people say, well, it's too high. Well, that's a mental thing. I could sit there and say, well, you say this was not a very good day down here, therefore probably not going to get continuation to the upside tomorrow. Well, things happen. And one of the things that makes trading very difficult is new news comes out in the market all the time. And what you have to be able to do is be prepared to handle that news. So yesterday, the reason I'm focusing on this was a slow trade. A lot of trade people may not see it that way, but this was a slow trade because it was a thoughtful trade. You had plenty of time to think about the gap rules, and you should go with that trade. So many times when traders first get started, they find far more reasons not to engage in a trade than they find to become involved in the trade. If I ask somebody why they didn't take a trade, it is amazing how many reasons they can list why they didn't take the trade. One of the things we say is take the trade and monitor for continuation. You'll be better off if you can get that mentality and learn. That means it's important to learn how to monitor for continuation. So for example, yesterday, take this trade, you get above the overnight high. Well, what you don't want to see is you don't want to see the market coming back down into this range, finding acceptance down below the opening, then below the 8-period range. So as a slow trade, this was a definite buy yesterday. The market then rallied up in A and B period. C period comes back to just within a tick of B period. D period tags B period perfectly. Then the market rallies. Well, I'm sorry. Here's the opening. Is green the opening, or is that the point of control? That's the point of control. We don't know the opening, do we, Julia? I don't think we know the opening, but here's where I want to go now.
The green dot, Jim.
Is that the opening? That's the point of control, not the opening.
No, but down in A period, right, the overnight.
Yeah. No, I'm sorry.
I'm sorry, the B period open. No, we do not. You could ask Terry, but I don't believe we can do that.
But so you've got an inside bar in C period. At some point, D period looked a single tick below C and did not take out B. Now, you don't know that till after the fact. However, I now want to address the subject of what is a fast trade. A fast trade is done by a trader that will make a very short-term decision, is very nimble, and is willing to reverse that if it's wrong very, very quickly. So the B period buy is a fast trade opportunity. It's not a slow trade. It's a fast trade because, you don't really have any excess here. You've got a lot of single prints and not much here. Now, but it's clearly a fast trade. I don't see any other slow trades in here. Questions came up, and several people throughout the day said, well, Jim, didn't you see any slow shorts in here from yesterday? And I said, no, I'll show you one late in the day. But during the day, I did not. Now, why would I not see a slow short, slow trader short? The market has gapped higher, values clearly higher, and momentum's clearly higher. So yes, you could have shorted in here, but there never appeared to me to be enough in the short for a slow trader. Is there enough in here for a fast trader? Yes, a fast trader might well short with the idea of, taking back at half back or taking back near the B period low, legitimate trade. But the point I want to make here is if you really want to get in trouble, mix the two, fast trading and slow trading. If you really want to mess yourself up, start mixing the two, and then you'll be all over the place. It is very important, at least in my opinion, that you sit down and ask yourself, what type of a trader am I? And once you have that answer, now you start to get a better idea of what kind of trades you are looking for. We're going to do a public webinar this afternoon, the last one to help promote the Mastery Series starting on Monday. But one of the things I'm going to kick off that webinar, and with maybe hopefully a little humor, is one of the questions that people that have been around for a while always know, we're going to feel Jim bristling. And that's when people say, well, where do I get in, where do I get out, and where do I put my stop? And that question should really be approached by answering a question with a question. So the first question I would ask is, well, what type of a trader are you? And then you get, in most cases, you'll get a blank look or a blank stare. And they'll say, well, I just want to make money. They haven't thought about, are they fast traders or are they slow traders? I think it's very important to have some idea what kind of trader you are, which should be based on your personality. I mean, you know, for example, if you're going to be a fast trader and buy the D period break, and if you say, well, you buy that and then you'll hang on if it doesn't work and it goes down, so, well, you know, I can't get out now, I can't take the loss. And, well, let me see if it bounces and comes back, and I'll get out if it comes back. Well, that is not the personality of a fast thinker. A fast trader, you buy this, it either works or it doesn't work, and you're out very quickly if it doesn't work. Come down, fast trader again. G period finally comes down the first time of the day that the market stopped one time framing. And one time framing, you have to take out the previous period by 2 ticks, takes it out by 2 ticks, and then comes back. That, again, is a fast trade. You look down below, you failed, come back in, that's another fast trade. You have to be, once you come back in, you have to be right very quickly, and it's a fast trade. The market works for you. Now, I saw a slow trade in the morning, and if you were on the chat yesterday afternoon, I'm going to cancel this. If you're on the chat yesterday afternoon, in the L period, I did a slow trade. And I announced on the chat that I bought the 23.85 puts for, I think it was $550 or $275 a put. Okay, why was that a slow trade? It's a slow trade because I'm looking at the point of control. I'm looking at the sluggishness of the day, of the structure of the profile. I think there's a good chance that it gets pulled back to the point of control. I'm going to split it out again. And if you were watching the chat, I circled the IJKL and said, you know, one of the things I'm looking for is a spike late in the day coming out and taking out these lows and hitting a stop and spiking lower. Okay, so it was a slow trade. Slow trade because I thought about the trade. Things lined up that made me feel it was worthwhile because it was late in the day, and the market, the shape of the profile, made me believe that I had mostly short-term traders, not new longer-term buyers, and mostly short-term traders. Then there's a pretty good odds that they're going to have to liquidate late in the day because daytime frame traders, a lot have to liquidate before the day is over. We saw the same thing the previous day. I did the same thing the previous day. Now, if you're looking at the chat comments, I also made a comment, and the comment that I made was that the break, the liquidation in the afternoon, appeared to me to be only liquidation and not something that was more potent, which would be a combination of liquidation and new money buying. And why would I say that? And that was because it had a lot of trouble. M period took out these 3 by 1 tick first. It rallied, finally came back and took it. And it just, if it was new money, it would have taken it out, and it had been on the way very sharp. So these are decisions. Even though it was a slow trade, I still have to make decisions about monitoring for continuation. And seeing that it appears to be liquidation more than a more potent combination, I'm out of the trade. So what we did yesterday, we had at least I saw a slow buy here. I saw a slow sell here, and then I saw several potential fast trades in here, either on the long or short side. But it's very important to understand the difference. And people say, why do I do these? I don't do the short trades simply because it doesn't fit my particular personality. It's not a good fit for me. Okay, so that decision prior to getting into May 1st, that decision of knowing who you are you a fast trader? Are you a slow trader? It is a very crucial decision to make. Identify who you are, and if you don't know, then don't begin trading until you've answered that question. As we say, the market will help you find out a lot about yourself, but it can be a very expensive lesson. Okay, let's stop at this point, Julia. Let me take questions relative to what I've talked about up to here, and then I will go into the current market, if anybody has an interest.
Yes, we have a couple just specifics. Does yesterday's G period invalidate one time framing when it exceeds the F period by 2 ticks, or when it exceeds the D period by 2 ticks?
Great question. It invalidates the one time framing when it exceeds the F period low by 2 ticks. And very often you'll see on a day like yesterday, very often you'll see later in the day, usually one cessation of one time framing. And that allows inventory, short-term inventory, to come into balance. Sometimes markets can't go any higher because they're too long. And we say sometimes a market has to break before it can rally. Other times we say it has to rally before it can break. If the inventory gets too long, sometimes you have to flush that inventory out, replace it with stronger hands, and then the market can rally. And that happens very often on a day like this. So this was the change. Now, let's go on with the question, because yes, your first answer is yes, that invalidates the one time framing. One of the biggest traps that traders fall into is mistaking this inventory correction for a more serious downside auction. And I'll tell you, I learned that the hard way very often when I was a young trader. Unfortunately, that's not correct. I kept learning it as I was an older trader. What you get enthused, oh boy, there goes price. You get all wild, and all of a sudden you end up shorting with it, and you find out that you just sold at the low tick for the day. And then you were talking about getting stubborn. Now you're psychologically destroyed. But it was clearly because I didn't understand the process. It was years later, in fact, after I was teaching for some period of time, that I did understand this process, that this happens very often. And then as you see the market then one time frame higher for 1, 2, 3, 4, 5 periods, 6 periods, and it did stop again in the M period. But also as it was rallying, I'm watching. Let's back up for a second. One of the things we said we wanted to do is we wanted to use this and examine this idea of the continuous two-way auction process. So we have an auction to the upside. We have an auction to the downside. We have an auction to the upside, down, back up. Each of these auctions, if you know how to organize them, and if you know how to view them, will release certain information. This last auction up where the J 2 ticks above I, K exactly matching J, L 1 tick above K, and then making a new high up here. When I saw that happen, what was going through my mind is that these are the weakest of traders that have to have the market, almost perfect 2 ticks exact in order to become buyers. I know from experience that that's not what stronger hands do. So then it didn't bother me as much here, but here I'm equating something else. And this is, again, why we teach this from an immersion standpoint. Now I know I'm getting very late in the day, and you know that day traders very often have to close out their positions. Either it's a personal choice or they're trading on limited capital and they don't have the margin to carry the trade over the night. So it's a personal choice, or they're overfinanced or whatever. So I combined that and I said, okay, now looking at the auction, looking at the continuous two-way auction process, I now make a decision to do a slow trade. Then I monitor, again, I'm monitoring the auction down. And if you can look at the chat comments, you'll see the chat comment said I didn't see anything other than a liquidation, at least for now. Okay, let's continue to take some questions, please.
Yes. Can a fast trader let profits run, or does the fast trader have to take quick profits?
In my opinion, a fast trader that then worries about letting profits run will start to confuse the two between fast trading and slow trading. And before long, you won't be sure who you really are. This is why it is so important to identify who you are and what it is you're about. The worst thing that can happen is confuse those two. Now, clearly what happens to traders, you do a fast trade and that fast trade starts to go up and say, oh my golly, boy, I wish I'd stayed with that. I'm not doing that next time. And you can just see the process getting underway, that more than likely you're going to mess yourself up and be very, very frustrated. One of the things, Julia has traded with me. And Julia, after I finish a trade, where am I at?
You're flat. I don't think I understand the nature of
emotionally.
Yeah, we talked about this when you were vacationing in Hawaii, but we talked about letting it go. Yeah, you don't sit there and grouse and grouch and I can't believe I did that. Yeah, you just let it go. It's like, I don't care. Went 10 points lower. I couldn't care less. Onward. Because I mean, when you do, you only get your mind in the way to see the next opportunity and you compound the problem. I say this from experience.
That's why I saw the very positive comments from Julia conducting the webinars while I was gone. I was intimidated. I thought maybe I shouldn't come back because the comments were so good. But those feelings are true. And people ask me all the time, well, how did you get there? I don't know how I got there. I just know that, in the early part of my career, I was a whiner and carry-oner and all that. And at some point, I realized the futility of it. One of the stories I tell is a friend of mine came to me some years back and wanted to be a trader. And he said, he would invest all the money he had, which, if I would help him, which turned out he didn't have very much. What he did have was a condominium above Lincoln Center in New York. But cash-wise, he had very little. So he went on to trade. And I told him I really didn't think he could be a successful trader because his emotions were so high. And I remember one of my other friends traded with him for a while, and he broke, I think it was 7 monitors one year, getting mad and throwing them. Well, he then went on to make $1 million at trading in a very short period of time. At one year, he was 5% of the overall volume in the E-mini on the market. And I thought, well, I was wrong. And he made sure I knew I was wrong. Well, then it changed, and he could never trade again. He just couldn't get there. Luckily, he was smart enough that he took quite a bit of the $1 million out and invested it in other projects. And some of those paid off very, very nicely. One was a cosmetic company. One was a movie that was a big success in what's the film fest? It takes place in the U.S. in Utah. I'm just drawing a blank. But anyhow, I think he's tried 4 or 5 times to go back to trading. And
Sundance. Thank you.
Sundance, yeah. And just could never get back there. So, it was overall with the emotions in it. But I think it's so important you define who you are and stick to that. If you want to change, then make the change consciously. If you want to go from slow to fast or fast to slow, make the change consciously. And anyhow, I beat that to death. It's a great question, and I suspect that all of you understand what happens when you mix them.
Yes, and someone just asked me, where do I find JD member content? Can you type that in again? For the record here, there are manuals at the JD member site for that site, at the premium content page, right near the top. It's the first PDF hyperlink. And there is a manual for the training site under Trader Tools on the dashboard page. But member site, J. Dalton Trading content, most of our articles, public webinars, training site, all the Mastery series, all the intensives we've done back to 2013. If you keep it in your head that way, that might help. And I'm sorry to diverge from the webinar here, but I erased her question so I couldn't answer it privately. Okay, here's a question for you.
Okay, hold on. Before you do that, let me go over, and I'm going to show you a fast trade that just took place. The market's had a lot of volatility today. Yesterday's high is 2389.25. The market just came down in G period to exactly 2389.25 and rallied. That coming down and hugging at that level, that is a fast trade. You buy it. If you're wrong, you're out immediately, and you'll see what the market did. It just went back up and tagged the F period high. You're in and out of that trade very quickly, but that is a fast trade. It just happened as we're sitting here. Now, when I look at it, I think that increases the odds that we eventually come back down through this, because that's weak buyers to do it that exactly. But as a fast trade, it was perfect. So that is a fast trade that you just saw in action. Okay, other questions, please.
Yes. Do fast and slow traders monitor for continuation differently? And by the way, I just am full of comments, but we are having a webinar this afternoon that I should have mentioned at the beginning. If you are not aware of it, it is trading fast and slow and using references to do this. So if you were unaware that we had a public webinar, not a private, won't have a password, at 4:30 p.m. Eastern today, please go to jdaltontrading.com, webinars, upcoming webinars. You'll see the registration link there. I haven't placed the slides there yet, but I will be. So we're going to be going over this again. Is that a fair assessment, Jim?
Oh, absolutely. Yeah. Absolutely.
So
and then using the examples from the last couple of days. Okay.
Yes. Do fast and slow traders monitor for continuation differently?
Oh, yes, without a question. The fast trader, time is the real control mechanism for the slow trader. I'm sorry, for the fast trader. You want it to happen very quickly. You want to be in and out of that trade very quickly. If you looked at this G period, it tagged that low, and with almost couldn't take your breath away, it tags the F period high. You're in and out so quickly. Far different than what a slow trader would do. That's a great question. The fast trader really isn't hung up on monitoring for continuation. It's not the same process. It's time. You want it to happen very quickly. For example, if you buy the break in G period, at yesterday's high or a tick above it or so. And, that doesn't carry through to the upside pretty quickly. You want out because the longer it sits there, the greater the odds are that you're not going to get that bounce. What you want to do is you kind of anticipate that this market, it's a momentum traders market. This is what momentum traders do a lot. And so you're in and out, and you're in and out very quickly. Good question.
Okay. Yes. Questions about the L period yesterday. Number one, is the only reason you knew the market would go down after the L period high is because of the time of day?
Okay, first of all, let's say that I didn't know that the market was going to go down. It's an odds-based play. Yes, part of the reason for doing the trade was because it was late in the day, and I did think there was a good chance that traders would liquidate. And part of that was based upon the structure, these exactness in these. The structure right here, I, J, K, and L being so close tells me that's, pretty much a sign of weaker hands traders. But overall, the fact that the day was truncated, in other words, not elongated. If I had a combination of, momentum money and new money buying coming into this market throughout the day, I've had new, serious, more institutional buying. I'm not going to have such a truncated market. I'm going to have a market that is much more elongated. So if this market was more elongated, then I don't have nearly the interest because I'm saying, okay, I may be dealing with more serious money. When I see this truncated or non-elongated profile, I said the chances are I'm only dealing with short-term traders. And if I understand the one of the statements we make as a trader, you need to understand the personality of two people, yourself and those that you are competing against. So I'm factoring in that I'm competing against these people and these short-term traders, and I think they're going to get forced to liquidate. But I'm also basing other information in order to get to that odds-based, opinion in there. Then other people ask, well, when did you do the trade? Well, if you look at the price was $5.50. Obviously, to get that price, I had to be up in here. So then they say, one group says, well, how do you know? And I said, well, I don't know. It's an odds-based decision. And, I'll take my chances. I've watched it all day, and I think the odds are in my favor. So that's one question I get. Then the second question I get is, well, if I wait till it's back into the body of the profile, am I too late, to the trade? Have I missed the trade? And those are two common questions that come up all the time. And both are really based on fear. The first one is based upon, how did I know what's going through the person's mind? Well, I don't know if it's going down. I could get really hurt. The other one says, well, did I miss the opportunity? And I'm looking there as making my own judgment, and I'm simply saying, based on the information of reading market-generated information, and remember, we started talking today about understanding the continuous two-way auction process. Don't ever lose track of that thought. Looking at the continuous two-way auction process, that's a decision that I arrived at, processing that information. Okay, other questions?
Several. The second L period, just while you're on the L, and maybe you want to split it again, was the rally in the L period yesterday an example of the market having to rally before it broke lower?
No, I don't think so. No, I don't think so.
You just explained, and of course he asked this question prior to your explanation, but it wasn't really, I just wanted to get that out.
No, a rally before it went lower would be from a market that was too short, not a market that was too long. Yesterday was too long, just the opposite.
Okay. How are short, intermediate, and long-term traders identified in the auction process. Can you give a quick hit to that question?
Sure. That's why we start every report using the, hold on, let me go over here. The monthly, followed by the weekly, and then the daily. It helps us understand who's really in the marketplace. So let's go back to the monthly. And obviously, when I'm going, you see this trend going along here for so long. Who do you think's involved? I mean, it doesn't take, you don't have to overthink it to understand this is longer term money making continual new commitments to the market. And the market's just trending up, and it's went on for quite a period of time. Then you look, and markets go, and then part of what we're talking about is understanding how the auction process works. Remember, we just saw the continuous two-way auction process yesterday, looking at very short-term time frames. There, one auction, another short-term auctions up and down all the way. Markets are always going to levels where two-sided trade can take place based upon that time frame. Now let's go back, and when you look at the monthly, the same process, the continuous two-way auction process, occurs in all time frames. The long term is going higher and higher and higher. Finally, the long term, you get a break in here. Then the market immediately goes higher. Then you get a break. And this is the market moving sideways. So the market rallied long period of time. You got an unusual break. Market rallied again, and you came back again. A lot of times when we talked about this, because we were educating at the time, and many times when this happens, it's an indication of where the market wants to go. It's just a little bit too early. So then for 3, 4, 5, 6, 7, 8, 9, 10 months, it rallied again, but it never really went anyplace. Then it broke again. Then, so we spent a long time in here. But so the market went one time frame on the long-term basis, then it moved sideways. So long-term trend was up. Intermediate term trend became balancing to down, up, down, and then back up. So again, the same thing happens in all time frames. And you get that perspective by starting with the monthly, weekly, and daily. Too much time is spent with traders constantly saying, am I seeing long-term money? Well, what's going on in here? Too much time is spent focusing on that. Look at the monthly, daily, weekly to get a better idea for yourself. And don't stress about it. Don't over stress about it. Matter of fact, I think as you're first getting started, you will be much better off if you think in terms of only two time frames. The day time frame and all others. When you see an inside day like this, okay, understand that's the day time frame. When the market gaps out of that, there's at least some element of some other time frame other than day time frame involved. If you think in terms of that, I think you'll simplify your analysis and your trading early on. Too many people, they stress over it and it becomes a hindrance, not a help. But start with the monthly, daily, weekly, and you'll start to get a better idea. Okay?
Okay. Back to a fast and slow question. If anyone could successfully juggle both fast and slow modes, we know Jim could. Is he not doing exactly that when he builds an option position but trades futures against it as a hedge?
No, not really. Because it's a whole different mental picture. For example, where was it? Oh, for example, on the 24th, I also bought puts at the high, and then when the market broke overnight and didn't follow through, I went long some futures against it, and that had nothing to do with playing between the two time frames. It was just simple, at least in my mind it was. It was just simply a risk consideration that I'm long futures and I have a very low risk situation. If I'm long puts and long futures, what kills me is if the market does nothing. What helps me if the market makes a pronounced move either up or down, and then that becomes beneficial to me because I never would be long more than a half, 50% of the futures against the call. So even if the market broke, really sharply, and my calls were fairly close to being in the money, the delta will increase sharply on the puts that I'm long, and it will start to exceed the loss on the futures. On the upside, the delta on the long quickly outpaces the loss on the put. So no, I don't see it that way. But I know that I am incapable of doing both kinds of trades, long and short term. I've tried it in the past, and I always end up getting myself messed up and losing track of where I am, and then I'm in trouble. Okay, other questions?
Yes. I lost it.
While you're looking for that, here was another fast trade. It sounds strange because we did it once, but it came down. G took out the previous G by one tick. Previous G period low by one tick. It made the G period low. It rallied to the F period high, came all the way back down one tick lower, and then again it was another fast trade in there.
Can you? Sorry.
Go ahead.
No, I didn't mean to interrupt your thought.
Oh, no, that's okay. I was just pointing it out. While you were looking for the question, I was just pointing it. There it was again. But you understand how fast you've got to be.
Yeah.
This happened very quickly.
Well, it's classic momentum buy, and they have a lot of brawn. I mean, they have no fear. It goes down there once, they take it. Comes down again, they take it. I guess it's that old adage you say, traders do what works until it doesn't work anymore. But it's just amazing. I wouldn't want that trade for anything. But they do it, and they make money. So who am I?
Well, they make money until they don't. And usually when they take it away in big size. Yeah. Because they get complacent. So it's that last buy. Here's half back. Here's the previous day's high. As Julia just said, these are traditional momentum traders buy points. Very mechanical. Markets are very visual. It's an easy trade to see where it's coming because there's half back. There's the high. Very visual reference form. Okay, other questions?
Can you be a fast trader on some days and a slow trader on others?
I think you're asking for trouble. It's the same answer I gave before.
Okay.
It's one of those things that seems so appealing, and you're sure you can handle it. You're sure you're different, but it is amazing how you'll mess up your mind. Just something that may not sound related, but it is. What I discovered some years back, because I do some writing from time to time, and if I start in the morning and I write before I trade, I can't trade for anything. And I mean, I can do the morning report because I'm on my, but if I write something else, it must be that it takes a whole different thought process. And if I'm writing and then I try and trade, I can't get into trading. I can't make that transition. And I might as well just forget the day. So I don't write anymore. Nor do I read
in the morning.
shortly in the morning before the market opens. Now, I may read during the day once the market's underway, just to keep myself from over trading, because I'm an addiction. But anyhow, I think this question, everybody will go to, oh, I can fast trade this and that. I tell the story about the guy that worked for me at UBS that managed about $5 million. And when he left, I suggested that he might get in trouble because it's a different atmosphere. Well, a year later, he came back and he'd lost $4 million of the money. It had been taken away because he didn't have performance. Well, when he was working and running the money, he was just making slow trades based upon observation he made. And he was very good at that. He's very analytic, very smart. Then when he went home to trade on his own full time and manage his money, now he falls into the trap of trying to make short-term trades. These fast trades were slow trades, and it was a disaster. It's usually a different mindset, and you'll fall in the trap of trying it, and but maybe having heard it once, it'll filter through after you've tried it. Okay.
Yes. Can a slow trader let a trade continue to run if the market moves into a multi-day/week run?
Oh, sure. Again, even if you're a slow trader, you have to make a determination. Are you going to take trades home overnight or not? I mean, you can be a slow trader and do slow trades throughout the day, but not the next level, which you're taking trades home overnight. Now, I try not to take trades home overnight unless they're hedged. So I would never take a futures trade home overnight unless it was protected by an option. I might take an option home overnight without being hedged, simply because the hedge is the option. I can only lose what I paid for the option. That may be substantial, but it's, in one swell swoop, it's not going to put me in the poorhouse. But again, you have to define what you're going to do. I think, as a short-term trader, I think you're overall going to be better off by not taking trades home overnight, unhedged trades home overnight. It is amazing. We all want to think that there's some predictability of the market, and we want to think we can figure that out. Well, with the U.S. election, the majority of people had it wrong, and now we come in Sunday night, and you get the French election, which goes into a runoff, and I certainly didn't anticipate that you're going to get this big move out of there, and then continuation today. So there's so many unexpected things. The world is so large, and we're so impacted by things that can take place in other countries, whether it's a missile firing or a threat or an election. So I just think overall, your odds as a short-term trader are going to be better coming in with a fresh perspective every morning.
Okay. Is a fast trader the same as a scalper?
No. I'm sorry. Yes, a fast trader is the fast trader is a scalper. Yes, not in the traditional sense. In the traditional sense, a scalper, and it's a term that's very, very poorly understood. In the traditional sense, a scalper was on the floor of an exchange, and they were trying to be the bid and the offer. So if somebody wanted to buy something, they'd sell it to them at 10 1/4, they'd buy it back in 10. That was the original, idea of a scalper. And then what happened to that type of scalper? The algorithms and the electronic trading has really made that go away. Traders that try and be scalpers now are generally very unsatisfied. It's a very difficult thing to do. And the volatility to me, a fast trader, as I define it here, would be the next step of a scalper from the days of the floor. Good question.
Could you explain your comment at 10:47 on the chat regarding starting a new profile with the new high if it holds?
That was a comment yesterday, not today.
Okay, maybe I put today.
Yeah, there was a comment yesterday. And all I'm saying is again, I got some questions about it. And it's just, if you take a look, here's today's profile. A, B, C, D. Okay, then E period broke and came back and got back into yesterday's range. If you start a new profile with D period at that high, then you see D, E, but then you see, okay, no follow through, and F comes back way up in E. So then at that point in time, I just merge them back together. What I want to be able to see, just as I can see here, one time framing higher, I want to see starting from the high, do we one time frame lower? And we didn't. So I merge them back together. That's all. It don't make anything more out of it than that. And I want to see what I'm trying to avoid is having had a change take place in the auction, and it was masked because I had this condensed profile. So I keep a collapsed or condensed profile here, and then I keep a spread out profile here. So I can quickly see the A, B, C, D, and then I can see the D, E, F inside. I can see it very well. So for all practical purposes, I can view a new profile anytime I have a high or a low. So here's a low and E period. E, F, G, H on one time framing higher again. That's all it means. It's just, I am just trying to not have information masked by being hidden within a very a full profile. Good question. Thank you.
Okay. Would you have Jim make his chart just a little larger, please? Okay.
Dealing with all you old people that can't see.
I know. We've heard a lot lately about the VIX and bears capitulating. Does Jim follow the VIX? Do you think this current market behavior has to do with the idea that tax reform will lead to increased corporate profits, in essence creating a buy the rumor atmosphere?
The only thing I reflect on is the emotions. That, as I said earlier, if markets were rational, we wouldn't have gone to the level we went down in 2000 and then take years before we got back to that level. There's a lot of emotion. And, you know, after the election and everybody says, oh boy, we're going to get all these wonderful policies, and everybody wants to make sure they get out in front of it. Nobody wants to miss it. And, you know, they forget that, you know, historically this has happened in the past, particularly when Republicans have been elected. Everybody gets all excited, and then you get significant breaks later when they find out it takes a little longer than initially anticipated. So I think there's just an awful lot of emotion in marketplaces, and a lot of fear that people don't want to miss the opportunity. And you get this stampede effect. You know, one person starts to buy, so the other person starts to buy. And let me put this in a different perspective. I've said before that in one of my past jobs, I probably placed something on the order of $80 billion with professional money managers. Am I in love with professional money managers? No. You just saw recently that, you know, majority of them didn't beat an index over a 15-year period. You also find that a money manager, professional manager that beats the index 1 year is very unlikely to do it 2 or 3 years in a row. But one of the things that professional money manager, let's say that I was a professional money manager, I was pretty good, and I ran quite a bit of money. All of a sudden, I built a cash position of 10%, with the average being maybe 2 to 3% cash that these managers will have. But now I think the market's really weak, and I built a position of 10% cash, and I'm wrong, and the market then rallies. I am going, my performance is going to look like that of somebody that's short. Because even though I'm not short, But the fact that I have 10% of my position in cash, if the market goes up, I am going to underperform any of these long managers that are more fully invested in the market. Now, that's a pretty easy thing to understand. But now what let's go to the next step, and that is that these people that sit on the boards of these pension plans and things that allocate money, they look at performance records and they said, oh, this guy didn't do so well in the last quarter, so they don't put their money with him, or they withdraw the money. And so now, as a money manager, you're actually better off. You're better off to have relative performance rather than actual performance. In other words, if your competitors are down 5%, and you're okay if you're down 5%. You're not going to lose a lot of money. If they're up 5% and you're only up 2% because you weren't fully invested in the market, there's a chance that an awful lot of money is going to walk out your door and you're not going to be managing. That's the facts of life. And it's amazing. These people that sit on these boards, they're looking in hindsight and they're looking at numbers and they're making some decisions. So a money manager, no matter what he may think, is when this market rallied following the election, there are a lot of money managers that may have had more cash than they normally carry. In order to save their business, they're almost forced to come in and put their money to work. Otherwise, if they don't, they may underperform their competitors and it may be very costly to them. They may lose a lot of money under management. Okay?
Since value never got back to unchanged yesterday, if you want to pull that profile up, should we have expected a break higher as we did yesterday based on this? Was the last exact pullback to the mid in G period a good long? Maybe you could split that, please.
I wouldn't think so. I mean, so many times to look in hindsight. But, I look at this. The G period was the low. It was also the low of the overnight.
Oh, that's the overnight from today. Unless it was overnight yesterday, too.
No. This was yesterday. This is what traded last night. The
last night I'm low. Sorry. I thought you were referring to G periods prior overnight low.
No. I'm talking about right here. But, when you say that this was just a buy, the chances are that, and this is so truncated, this was a very mechanical buy to come down at this exact level.
If you push your chart over to the right, they can see why, because I think that was the high. Wasn't that a high? You have a red line there. Maybe it's just from today. Pardon me.
No, it's just from today. From today.
Yep.
It's just, this was just mechanical momentum buying. It's where they buy, so close to this. And so I would have said I would have thought the chances of going higher like we did today were very low because the inventory is weak. Long inventory is very long, and it's probably in weaker hands. And the market started out, it wasn't doing so hot. And then, as I pointed out to people, early on, you got at 10:30 on Wednesdays, you get the petroleum report. 10:30 on Wednesday, the report triggered a rally in crude oil. That rally in crude oil was then followed by a rally in stocks. And, when there's nothing else, and traders don't have anything else to look at, and there was nothing going on, they started following that. Then that got the momentum buyers back alive. I mean, that's what I think. Yeah, so low confidence day. But no, I don't think that was a good buy yesterday. Good buy in hindsight. I don't think it was when looking at the odds. And so, okay, another couple of questions. We're getting pretty close to the end.
Excuse me,
Hello?
I was on mute.
Oh.
The fast trades from yesterday that you didn't take because you didn't see much in them, I saw a lot of potential in them because I was thinking in the market, if the market breaks through that 82 quarter level, a lot of stops should be triggered. Plus, the long inventory panics, and we could get a good push down. That is why I saw what I thought was a good short in there. Is my thinking incorrect here or wrong?
I'm sorry, come back at me one more time.
Certainly. The fast trades from yesterday that you didn't take because you didn't see much in them. I saw a lot of potential in them because I was thinking if the market breaks through that 82 quarter level, and a lot of stops should be triggered, a lot of stops should be triggered, plus the long inventory panics, and we could get a good push down. That is why I saw what I thought was a good short in there. Is my thinking wrong here?
Yes, I think so. The direction was up yesterday. The value is clearly higher. And what you're thinking at that point, it's a question of what you, there's nothing wrong with the visualization of what could happen. But you're fighting the trend. Granted, there's nothing wrong with your thinking. You're right. If you got below this, you could have one heck of a move to the downside. But many times you get hurt because you're better to be late than early when you're thinking that kind of trade. And you get early because you're afraid you're going to miss the opportunity. And when you get into the trade because you're afraid you're going to miss the opportunity, you are in big trouble because now you're focusing on your feelings and this fear of missing the trade rather than on what's going on. What was going on in the market, the trend was up. The trend's been up for the last couple of days, gap higher 2 days in a row, which tells you that, there's really no sellers in there at this point in time. And this market was buying all day long yesterday. And I understand the fade debt. Now, I tried it. I understand what you're talking about because in L period, I bought the puts because I could see the same thing you saw, and I was aware of that. But I'm saying, okay, I think I have a chance to get a position on, and then after I get the position on, what am I going to do, folks? Monitor for continuation. You get the trade on any place in here, it's hard. You don't have very good trade location. Risk control is a factor of trade location. My getting in the trade here gives me pretty good risk location because I know pretty quickly if I'm right or wrong. And then you saw from the chat comment yesterday afternoon, I said I didn't see anything other than short-term liquidation. So part of monitoring for continuation is when this broke, what I would like to see, I'd like to see a combination of liquidation and new money selling. The fact that this was so hard and it didn't follow through, there was no new money coming in to sell. So that means that trade's not very valid. So getting a trade on, monitoring for continuation. But I think what you saw was not unreasonable, but understanding the other side that you're going against the market. On a trend day up like that, most of the people, what happens when you run, most people are thinking about, oh my golly, price is higher. They're thinking about selling and shorting all day long. Instead of, better traders are thinking about getting long, buying the market because the trend is up and they're going with the tone on that particular day. So nothing wrong with your thinking. The execution, and I think there was more wishful thinking than there was of realizing that, that the auction has started on the downside yet. Okay, long answer, but it's the reality of what is going on in the market right now. Okay, another couple of questions. Julia, you on mute again?
Sorry, everyone. Value was overlapping to higher when we started the day. It has been steadily moving up and is now above value area of yesterday. What do you make of this?
Well, today, if you were looking at the market today and wanting to get short, part of monitoring is you're saying, okay, I thought the market looked pretty weak early on. But one of the things I kept saying, if you look at the chat comments, I kept saying, okay, we're going to change time periods. Now visualize what the profile looks like and monitor from there. So We go down and we change time period. C period here. There's the high of yesterday's value area. And early on, we were overlapping this to the downside. But as C period came along, didn't take out B period, guess what? Value's going higher. Value's going higher. So part of monitoring for continuation is staying with value in there. And the value was higher today. Do I like the structure and the anomalies? No. But value is higher. And as I've said a lot of times, monitoring value can keep you out of a lot of trouble. Okay? One final question.
Amen. No, it's true. Yes, Paul, he said that the E-period break was news-related and not long liquidation. He's just stepping in.
No, it's still long liquidation. It's still long liquidation.
But news-related. Okay, maybe that's a good thing I asked. Let me ask for everyone because I didn't give them the luxury of hearing it. Let me just say it. Jim may have covered this. I stepped away for the last half hour. But did he say the E-period break was news-related and not a long liquidation?
No, I said earlier I thought it was long liquidation based on a comment that Speaker Ryan made. However, it is still liquidation, news-related, but it's still liquidation. Okay. So, yeah, those don't have to be mutually exclusive. But, you know, this whole market, I mean, if a market's not jittery, you know, crude oil, things like that doesn't affect it. If a market's really trading on its own, this market's so jittery, there's no real conviction in this thing. You know, here we came down. One time we bounced off of yesterday's high. We came down one more time, looked one tick into it, bounced again. Half back. I mean, very mechanical trading. This is not good, solid buying. This is trading money. This is momentum buying. Okay, final question, please.
Yes. How about this? Is today's market trying to go higher with period E being a balancing period? The confidence is low, especially in FGH auctions up now, which is very slow. How often does it happen that we have 3 days in a row pushing up with gaps?
Well, we only have 2 gaps, I think.
Well, the third day creating the second gap. But still, you know, how often do we see a gap, next day gap?
Well, we had not too often. We had 5 of them following the election, which was the most I'd ever seen. You know, it's just, but the more important thing is I've been saying and writing for some period of time, there's a tremendous amount of uncertainty in this market. The trends are all up, tremendous amount of uncertainty. And where you'll get frustrated is trying to make more out of the market than is there. Today is just, it looked low confidence from the beginning. It's continued to be low confidence and volatility. And sometimes you just stay out of markets. There's absolutely no shame in staying out of a market. But yet what happened, people can't stand it. They sit there and they oh, I'll do this, I'll do that. And before long, they've done several little trades. There are little losses, little profits. They're worn out, and the net is a loss. Discipline and patience are extremely valuable assets. All right, let's recap.
But before you do that, Jim, does contract volume seem to be low today? I have not seen 3 or 4 million contract days. And you know what, Jim? If you right-click on your window trader, we can see a comparison of volume. This might be helpful, but we are not affiliated with Window Trader. You do not need Window Trader to do this. We are a partner in business. So I'm just throwing this out to you while it comes up and we can answer the question that Joe has asked. So if you go to ESM, I think, help me out, people, if I'm not doing this right. Click on the volume stack, please, and right-click on the daily data values volume stack.
I'm sorry, okay.
No, let go of that. Let go of that. Let go of it. Go over to the volume stack for today and right-click, please. go to U-bars, extras, down the bottom, period statistics, no, I'm sorry, close that, calculate period statistics, go back, shut that panel and go back and do that one more time. Over the volume stack, right click, U-bars, extras, calculate period statistics. Okay, and you can make that larger for us so that we can all see it. Obviously the profile is not going to be very visible, but that's okay. So the question is, and this is an ex-market maker, professional floor trader, or professional market maker I should say, does contract volume seem low? I have not seen 3 to 4 million contract days. I have not been trading the ES though that long. So you can see here, I believe that the default settings in Window Trader is a 10-period average where you have low volume, it is red, or lower than the standard deviation. Lower than 1 standard deviation it will be red, and higher it will be green. So it appears at 1:30 Eastern, because Jim's computer is on Pacific time, it's 1,800 contracts lower, which is interesting, and at the 1 o'clock hour it was 50,000 lower, and you can see the delta from the prior, or the delta from the 10-period moving average. So it does seem lower today, but I don't know if that's substantial. I mean, we're looking at, what is it, total volume at this period, it's 51,000 contracts lighter than
let me go to someplace else, because that's not what I use.
well, he's asking about the futures volume, so I just share that with people.
Okay, how do I get rid of this now?
No, cancel that. Yeah, right click and go U-bars, extras, and I think you can click calculate again. No, calculate.
Oh,
Calculate.
I do it wrong.
Just click over it and do calculate. No, U-bars. Yep, extras, calculate, period statistics. It might. Okay.
Oh, okay. Okay.
All right, and shut that panel. Yep.
Okay, now I'm going to go up to, oops.
I'm surprised you just don't leave that browser open.
Well, I did have it open. I somehow got closed when we were doing this.
Okay, there's the New York Stock Exchange volume.
Okay, so right now we started off, we did, we 363 the first period. That was opposed, that was about 100,000 less than yesterday. We were about 4.8 yesterday.
Well, okay, but it says delta 8,000.
Okay, so it was low. Okay, maybe I looked at yesterday wrong. It was, maybe it's 3.8, but it was low. Yesterday was low, today is low. Overall, you can see.
Yeah, it's peeling off. The volume is lightening.
It's peeling off all day. So from a risk standpoint, higher prices all day have been cutting off activity. And notice, we were back here twice. We're now back here a third time. We're back here a third time. So again, as I pointed out early on, confidence has been extremely low all day. And these are the days you just kind of get caught up on. And they're treacherous days. All right, so let me recap for those in the Kickstart program. One, thank you for joining us. I hope that this extra time has been beneficial in order to see that you get more money or more value out of the program when it starts in May. Remember where we started. The most important thing is to begin to view the market through the continuous two-way auction process. There's two types of traders. There's momentum traders, there's value traders. What we're teaching is value trading. We do not ignore momentum trading. We do not ignore it. We're very much aware of it, and not being aware of what is going on from a momentum standpoint will be very detrimental to your trading health. But we organize via the market profile. That just organizes the market's continuous two-way auction process. This allows us to see the structure of the market. We go through the course. What we're trying to do is read the structure and interpret the continuous two-way auction process. Next, we went in, talked about the importance of describing what type of trader you are. Are you a fast trader or a slow trader? That's a pretty important distinction. Now, if you're a fast trader, you can take it, a slow trader, you can go to another level. You take trades home overnight or not. Or are you a swing trader? I mean, you can extend that out. But the basic early discussion ought to be with yourself. Are you a fast trader or a slow trader? That will have an awful lot to do with how you approach the market, how you see risk. But the worst thing, in my opinion, you can do is try and mix the two. Then you get yourself terribly confused, terribly frustrated. Probably some of the most valuable assets you have are patience. First of all, doing your nightly preparation. When we start on Monday, you should be doing your preparation prior to seeing what we put out. Then compare. Early on, you'll probably defer to what we put out. As you get experience, there'll be many times you say, wait a minute, I think Jim missed this. And that's a sign when you're really growing and you're becoming independent, because your goal is to become independent from other people in the market and independent from me and dependent upon yourself. That's where the pride and that's where the professional advancement comes from. But doing that preparation yourself, I think, will keep you out of a lot of trouble, identifying who you are, what kind of trades you want to take, and having the patience to stay out of a market that is low confidence or that you really don't understand. Anyhow, again, from both of us, let me thank you, and we look forward to being fully underway come Monday, May 1st. Thanks.
And thank you, Jim. Again, a quick reminder for anyone coming in late, we have a webinar at 4:30 p.m. That's a public webinar, so you'll find it at our public site, jdaltontrading.com. So check it out if you haven't registered already and you have the time to come. Also, I guess I'm trying to make sure I mention all that there is to mention, but I do want to say thank you for being here and being a part of this program. We appreciate it, and we hope you got a lot out of it and more than the time you invested in it. And please stay in touch with us. If we can help you with your enrollment or whatever is going on, questions, you're on the fence, don't hesitate to call us. We'd love to talk with you. And if you're deciding not to do it, we completely respect individuals' choices and respect you, and Jim and I wish you well. And maybe we'll meet again after the Mastery Series. So with that, we hope all of you have a great afternoon. We'll see you back here in a few hours, and next week we are hitting the ground running. So get ready, do some preparation this weekend if you're a little leery or fuzzy and gray about certain concepts. Read the articles at the members site. Do what you can do so that you can get all that you can possibly get out of the program. Okay, so I'll get off my pulpit now, and I will say thank you. We'll have this recording up. It may take about 2 hours to load. For some reason, these conversions are taking too long. Anyway, we will have this recording up for you, though, okay? And be well, God be with you, and we'll see you back here at 4:30. Ciao. Bye-bye.